Good morning. I'm Gary DeWaal, and this is Bridging the Weeks from November 20th to December 1st, and today is December 4th, 2017. After a week of significant volatility, Bitcoin moved a step closer to mainstream acceptance as three exchanges regulated by the Commodity Futures Trading Commission self-certified non-deliverable derivative contracts tied to prices on spot Bitcoin exchanges. The CFTC declined to stand in the way, despite noting, quote, there are concerns about the price volatility and trade practices of participants, end of quote, on the relevant underlying markets. The three CFTC overseen exchanges agreed to, quote-unquote, significant enhancements in their original proposals to address CFTC concerns. Separately, CME Group exchanges brought and resolved disciplinary actions involving claims of wrongful trading practices. The holiday season is now formally underway with the lighting of the big tree in Rockefeller Center in New York City. So I can hide under a rock as soon as possible to avoid the avalanche of tourists in Midtown. Let's get started. On December 1st, three exchanges regulated by the Commodity Futures Trading Commission self-certified new cash-settled derivatives contracts based on Bitcoin. The exchanges are the Chicago Mercantile Exchange, known as CME, the CBOE Futures Exchange, known as CFE, and the Cantor Exchange. CME and CFE propose to offer margined futures contracts related to the prices of Bitcoin traded on certain enumerated spot exchanges, while Cantor proposes to list fully collateralized binary options based on the prices of the same virtual currency assessed through less fixed methods. Only CME announced an intended launch date, December 17th, for trade date, December 18th. Contemporaneously with the three exchanges' self-certifications, the CFTC issued a press release noting that it had, quote-unquote, extensive discussions regarding each of the three exchanges' proposed new contracts. As a result, said the CFTC, each of the facilities, quote, have agreed to significant enhancements to protect customers and maintain orderly markets, end of quote. The CFTC separately noted in a backgrounder also issued on December 1st that its staff had considered the potential risk of default of the three exchanges' derivative contracts on the derivative clearing organizations clearing the products. However, said the CFTC, quote, based on analysis of different stress scenarios, staff estimates that any potential impact will not be significant to a DCO, end of quote. As a result of these developments, soon there will be three principal ways for U.S.-based hedgers and speculators to gain exposure to Bitcoin. Buying and selling spot Bitcoin. This can be accomplished by any person by a direct trade with another person or on an online spot exchange, such as the enumerated spot exchanges underlying the soon-to-be-traded CME or CFE Bitcoin futures contracts. Although at least in the U.S., these exchanges are subject to anti-money laundering requirements of the Financial Enforcement Network of the U.S. Department of Treasury, they are not subject to functional regulation on their marketplaces by any federal or state regulator. Buying and selling Bitcoin through a Bitcoin deliverable swap contract. This can be done by qualified persons known as eligible contract participants. Currently, Bitcoin-settled swap contracts trade on LedgerX, a CFTC-approved swap execution facility, and DCO. And finally, buying and selling non-deliverable Bitcoin derivative contracts. This can currently be done by eligible contract participants through the purchase or sale of a non-deliverable Bitcoin forwards contract on the Terra Exchange, another CFTC-approved swap execution facility. This will soon also be possible for any person to do through the new derivative contracts self-certified on December 1st by CME, CFE, and Cantor, all CFTC-approved exchanges. No Bitcoin will pass in connection with transactions in these contracts. These products will solely be cash-settled by reference to Bitcoin prices on spot exchanges. CME Group exchanges brought and settled disciplinary actions alleging wash sale, spoofing, and impermissible exchange for related position transactions. In two disciplinary actions, one involving Image Securities and the other its employee, Ramakant Gound, the Chicago Mercantile Exchange alleged that from December 1st, 2014 through March 31st, 2015, the firm, through its employee, engaged in multiple matching buy and sell orders to move positions between different accounts of the firm to quote-unquote manage margin calls. To resolve these matters, Image agreed to pay a fine of $85,000 US, while Mr. Gound consented to pay a fine of $10,000 US and be subject to a 5-business day all CME Group exchanges trading suspension. Robert Overholt agreed to pay a fine of $25,000 US and serve a 30-day all CME Group exchange trading suspension for allegedly entering orders involving live cattle future contracts without intent to execute these orders. This conduct purportedly occurred on quote-unquote multiple occasions from October 12, 2015 through December 8, 2015. Typically, said CME, Mr. Overholt would place a large order on one side of the market to induce execution of a small order on the other side, and then cancel the large order after the small order was executed. Finally, Citigroup Global Australia and AMP Capital Investors, in 2 separate disciplinary actions, agreed to resolve allegations by the Chicago Board of Trade that on April 15, 2015, the firms executed 2 EFRP transactions that were contingent upon each other, quote, wherein each position was established and offset without the incurrence of material market risk, end of quote. Each firm agreed to pay a fine of $15,000 US to resolve their disciplinary action. Well, that's it for this week's edition of Bridging the Week. As always, there's more information in each article and more articles on the article version of Bridging the Week on the website. Check it out. I'm Gary DeWaal. Have a great week, and until the next edition of Bridging the Week, ciao.